Hello and Happy New Year to all of you. This is the first update on the Value Opportunities Fund in January 2020. Let me start off by reminding you what the Value Opportunities Fund is about. It is a multi-cap fund which is managed with a value tilt, and in the SEBI categorization framework, it fits in the category of value funds. Our approach towards managing this fund is to manage it with the principle of intrinsic value rather than an excessive focus on cheap multiples. The valuation tilt of this portfolio is visible in the way that it builds its exposures either to sectors or to segments of the market where we tend to emphasize the attractiveness of valuations. At a stock level, our focus is more on a barbell approach, buying what the market underestimates, which could be growth, return on capital, or it could be the potential for a turnaround. Moving on to where the portfolio is currently positioned to take advantage of where we think risk reward is favorable, our current exposure to mid and small cap stocks has steadily climbed over the year, and at the year end of 2019, we are at about a 30% exposure. We think that if the market remains attractive for small and mid caps, the exposure could climb further, but this will be more on a bottom up opportunity. At a sector level, the single largest exposure is in banking and financial services. Our largest overweight positions within that are in private sector banks, where we think credit costs are likely to normalize. We have held these positions through the year and remain positive on these names. The other sector where we have a significant exposure is IT, but this is now a neutral weightage in the sector compared to where we were 18 months ago. In terms of the overweight positions in the fund, the single largest overweight is in pharmaceutical. We think the domestic market growth opportunity remains something which is not fully reflected in valuations, and we think the phase of consolidation and pressures in the US market are now behind us. What has been a disappointment, however, has been continued quality related issues in this sector, and therefore we have sort of run a large number of names within the portfolio to try and manage this risk. The other sector where we are overweight now is in the automobile sector, where due to the correction last year, we think some of the valuations have become more reasonable, but our exposure is broad-based across OEM companies and also auto ancillary companies. Finally, in the consumer goods space, we have increased our exposure in some of the staples names where we found that the names had derated. But in general, we have remained wary of the consumer goods space because of otherwise very high valuations. We do, however, own some companies in the consumer discretionary space where we think there is a very long growth runway. Beyond that, we continue to look for opportunities in sectors where we think value is cheap, is available, and where we think there are supply side disruptions. And some of the recent additions in our portfolio exposures to real estate and also to telecom reflect this fact that we think the survivors who come through this difficult period will be much stronger in the days ahead. So that's it for a wrap this month on where the Value Opportunities Fund is performed, and we'll be back with an update next month again. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.